Welcome to a brief discussion of the components and concepts of enterprise budgets. It's important to know the pieces of the puzzle that go into building an enterprise budget and what those pieces mean. So when it comes to constructing an enterprise budget, it's important to know what the pieces of the puzzle are. And so they amount to the revenue items, operating or variable expenses, ownership or fixed expenses, and what is remaining, and that's a profit. The profit is shown as a residual earning after resources utilized in the operation have been assigned a payment. Revenue items could amount to, essentially, it's your value of production. It's the price times quantity. But other items could be government payments, insurance proceeds, and other revenue items. So in this wheat budget example, the total receipts amount to $166 per acre. The next component is variable costs, or otherwise known as operating costs. Variable costs are those operating inputs that vary as the level of production changes. They are items that will be used during one production period. Some examples are shown here. One special note: many times no differentiation between owner-supplied or hired labor is assumed. If a farm operator or family member supplies labor, a wage rate or salary that represents earnings if employed elsewhere would be shown. This illustrates one of the most important concepts in economics, and that's opportunity cost. The opportunity cost of labor is the return the resource could earn when put to its best alternative. So in the wheat budget example, the total operating cost is around $145 per acre. Fixed costs are the next item, and in determining the overall enterprise profitability, fixed costs also have to be part of that profit equation. Fixed costs are not affected by short-term enterprise decisions and do not vary with the level of production. Fixed costs are those ownership costs associated with buildings, machinery, and equipment that are prorated over a number of years. They may also be cash or non-cash in nature. Taxes and insurance on buildings are examples of cash fixed cost. Non-cash costs include depreciation and interest on the capital investment of your assets. Brings up an important point. Even if all your machinery is paid for, the investment you have wrapped up in capital assets could be earning a return elsewhere. That's another example of opportunity costs. So even if your ag real estate has been bought and paid for, that value also has an opportunity cost, as shown by the land charge. Funds invested in land could return or earn a return if invested in an alternative venture. It all boils down to putting a value and assigning a payment on a producer's own resource used in a particular production activity. So going to our wheat budget example, our total fixed cost is right around $89 per acre. When it comes to interpreting and analyzing budgets, it's important to remember to place a value on every resource utilized in the production activity. The profit or loss is what remains after covering expenses. But what do we really mean by that? Well, first, the returns above total operating costs is calculated by subtracting total operating costs from total receipts. When that return is positive, production is economically rational for an established enterprise. Positive returns indicate that the enterprise generates enough revenue to cover all variable costs and some portion of fixed costs. If the returns are negative, the enterprise is not generating enough revenue to cover even variable costs. So unless the producer is willing to subsidize the operation, for instance, taking some off-farm income and keeping it afloat, eliminating this enterprise will increase profits or decrease losses in the overall farm business. And determining overall enterprise profitability, fixed costs need to be part of that profit equation. The return above all specified costs is calculated by subtracting total variable and fixed costs from operating revenues. Positive returns above all specified costs signal a return to management risk. It shows how much is available for family living and rewards the producer for their management efforts and exposure to risk. So in our budget example, the returns above total operating costs is a positive $22. It's economically rational to stay in wheat production. However, the returns above all specified costs is negative, which means insufficient income is generated to cover all of the costs specified. The enterprise is not generating a true economic profit and is not self-supported because we just don't have enough revenue to make a payment for all of the cost items specified. Could be a short-term problem, or it may reflect a situation that has occurred over several production periods. And if that's the case, it's probably eating into our equity position, and we need to probably make some changes in our operation, reallocate some resources, or somehow generate some more farm earnings. It's all part of the variability in those farm earnings that production agriculture experiences every year. It is important to remember that when it comes to production agriculture, everything doesn't go just like you planned. Budget projections can be influenced by production and price uncertainty. How bad can yields or prices go before I can't cover my costs? A break-even analysis will help you determine what those values are. So in our wheat budget example, we had variable cost at, I think if you remember, $144 per acre. We need to subtract our non-grain revenues of $44 per acre to get our net cost to cover of $100.85. If we divide that number by $3.50 bushel wheat or 35 bushels per acre, we get our respective yield and price break-even levels. And those are those levels that we need in order to cash flow, in order to pay for all of our operating inputs on time. And if it looks like those levels are tough to achieve, what can we mitigate, or how do we go about mitigating the downside risk? Well, we can check into crop insurance, possibly. We can check into a sound marketing plan. Those are those risk management strategies that we should probably check out. One last thought. Unless you know your cost of production, you don't know if you're making a profit. That's why good financial and production records are so important when it goes into a budget. You need to know your cost of production in order to calculate your break-even levels so that you can calculate and determine that appropriate risk management strategy. If you can't pencil in a profit, you aren't likely to plow one or raise one. Keep in mind that if it doesn't look like it works on paper, it probably won't work in life. You might be able to prevent a very expensive lesson in the pocketbook. So don't have a bad day. Use those budgets, because the knowledge of budgeting and the ability to use them will help you make or save money.